Welcome to our CMA-focused video on lease accounting. In this session, we will explore lease accounting's key aspects. So let's dive in. Starting with the lease definition. A lease is a long-term contract between two parties, the lessor, the owner of the property, and the lessee, the one who will use the property. The lessee pays the lessor for the right to use the property for a specified period. What matters here is whether the lease transfers most ownership benefits and risks to the lessee. Lease Classification Test. Leases are categorized into two main types, finance leases and operating leases. We determine which category a lease falls into by considering 5 specific criteria. If a lease meets at least one of these criteria, it's classified as a finance lease, otherwise, it's an operating lease. Moving on to Lessee Accounting initial measurement. When dealing with both finance and operating leases, the lessee has certain accounting obligations at the lease's commencement. They must recognize a lease liability and a right-of-use asset on their financial statements. The lease liability is the present value of lease payments, while the right-of-use asset is the lease liability amount plus any initial direct costs incurred by the lessee. When it comes to subsequent measurement, for finance leases, the lessee needs to consider interest expense and lease liability reduction with each lease payment. The interest expense is calculated using the effective interest method, and the right-of-use asset is amortized straight-line based on either the lease term or the useful life of the asset. On the other hand, operating leases follow a different approach. The lessee recognizes a single periodic lease expense on a straight-line basis over the lease term. This expense includes both interest on the lease liability and amortization of the right-of-use asset. Finally, balance sheet and cash flow presentation. Financial reporting requires finance and operating lease liabilities and right-of-use assets to be separated from each other and from other items on the balance sheet. Additionally, lease payments for operating leases are classified as cash outflows from operating activities in the statement of cash flows. Thank you for tuning in. Don't forget to like this video and subscribe to our channel for more valuable content on accounting and finance topics.